Thank you for taking time to view this short update on the Church of Scotland Investors Trust Growth Fund. We had very strong markets as we moved through last year, 2019. However, as we moved into the first quarter of the new decade, we saw financial market conditions that we haven't seen for a generation. The coronavirus, which began in China at the turn of the year, and was largely ignored by governments, institutions and financial markets in the developed world until late in February, spread to Italy and Spain, and the associated death rate caused alarm these more developed markets. The response from governments were to lock down their populations, effectively closing developed market economies overnight. Millions of individuals and businesses lost a large part or all of their income overnight. Such a complete and quick closure of the global economy is without precedent. Equity markets reacted quickly and severely to this uncertainty, and we saw significant corrections as we moved through the last week in February and into March. You can see this on the top left-hand side of the slide. From a sector point of view, those sectors that are more exposed to economic activity, such as energy and financials, were worst affected by this. The energy sector was also impacted by a dramatic fall in the oil price as the OPEC Plus nations decided to increase supply at a time of reduced demand. Less economically sensitive sectors such as the healthcare, technology and consumer staples remained resilient, and you can see the performance of the sectors over the 3 months on the chart on the right hand side. As we move through this more uncertain period, interest rates fell to historic low levels. Investors sought out havens and government bonds performed very well. The performance of fixed income markets can be seen on the chart on the left hand side, with most producing a positive return as we move through the crisis. On the next slide, we show performance over 12 months. From a sector point of view, the sector performance is relatively similar, with financials and energy being the worst performers in equity markets, whereas information technology and healthcare proved much more resilient, producing a positive return over that period. The losses over 12 months were moderated somewhat by the strong returns that we saw in 2019, particularly in overseas markets where we saw a weaker sterling reduce the losses to UK-based investors. On the bottom left chart, you can see returns from fixed interest markets, again producing positive returns by and large, driven by interest rates falling to those very, very low levels. Looking at the portfolio returns on the next slide, we can see that over 1 year, the portfolio produced a negative return net of fees of 3.2%. This was slightly better than our performance benchmark, which produced a negative return of 4.6% over the year. Over longer time periods, 3, 5 and 10 years, the fund continues to produce a positive absolute return, which again is slightly ahead of the positive return from the performance benchmark. Positively, as we've moved into April, economies and investors have started to recover somewhat, and we have produced a positive return moving into April. The outlook continues to be very uncertain. We hope that a medical breakthrough, such as a vaccine, will allow economies to return to some element of normalcy. But how consumers and businesses react to the shock of the economic closure and what the new normal will be has yet to be seen. Over the short term, companies have reduced costs to protect cash flow and to ensure enough liquidity to trade through the current shock. Unfortunately, for many companies, this has involved either postponing, cancelling or cutting their dividend, along with furloughing or reducing staff numbers, which will have a significant shock and reduction to the incomes of many individuals and a corresponding impact on their spending power. The level of income paid out to equity holders will therefore be lower, And this has been actively encouraged by governments and regulators around the world to ensure companies are in a position to employ as many staff as possible and to ensure that they can recover as quickly as possible when economies are eventually allowed to reopen. The fund will not be immune from these lower income levels, and a lower dividend is likely to be expected from the portfolio as we move through the year. Looking forward, Newton will endeavour to seek out those companies with more resilient earning streams, with long-term business models that remain relevant and intact into the future for inclusion in your portfolio. We hope to see many of you at next year's event in person, hopefully when the lockdowns have all ended. Thank you.